Gold, stocks, and land. Time for a market review. Hi, everyone, and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Drew. He's always looking at all of these markets, but it is time to dig into some of those charts, the things he loves to look at. Keep us up to date on what's going on. How are you going today, Drew?
Good, Chris. How are you?
Yeah, good. Let's sort of start off with your big picture overview today, where things are at the moment. We've seen some very interesting movement on the charts recently. Some of us in the office are a bit confused. It's the old could go up, could go down scenario, which is never good in the short term. We always have our long-term views where it's going, but the short term can make it a bit confusing. What's your take currently?
Yeah, definitely. A couple of weeks ago, we did a video looking at the markets being at a pretty important turning point. There was a fork in the road, and essentially saying that now is not the time for complacency. We're either putting in some sort of what one would call a complacency bounce or a macro lower high with a bear market setting in, or we're about to shoot off to new highs. And, there might be a rally in risk. We could see the DXY fall off and a huge boost in global liquidity. Now, while that is the expectation from a macro cycle point of view in terms of the timing of it all, we did mention that we would track these markets quite closely for the next couple of weeks, just as this fork in the road is being decided upon. So we've done a follow-up video last week, and I thought it would be prudent to just have a quick look because there are a few promising signs, at least for the bulls, if that's the side of the market that you are on. And things are sort of playing out as we expected. So thought we might run through a few charts, look at inflation, and look at the bond market as well, just to help form that image.
Wonderful.
So to start with, let's probably first look at the DXY, just to get a bit of context as to what's happening with risk on versus risk off. Of course, a rally in the DXY tends to coincide with people bunkering down, ducking for cover, global liquidity contracting, and people moving into the global reserve currency as a safe haven. It also tends to be pretty difficult for risk markets to rally in this environment. Now, we were looking at the DXY over here, and based on the 8-year DXY cycle, we actually expected cyclically that the odds would favor a fall off in the DXY. Now, from a technical analysis perspective, it's very hard to form an opinion when the market's sitting up here because most people are expecting a continued uptrend because that's quite a strong uptrend. And that, looks like a Wyckoff distribution pattern in hindsight. But over here, you don't really know. It could have been a Wyckoff accumulation pattern. But cyclically speaking, we were expecting a fall off. That has happened. And looking at the 50% level of the DXY a few weeks ago, we had noted that it had broken down. We were expecting a back test. And then, really the fork in the road was either the DXY breaks back above this 50% level, holds above it, in which case we are favoring a macro lower high in most markets and probably a downtrend in risk, or the DXY fails to get above this 50% level, which is a sign of weakness in the DXY. And with that inverse correlation, you would expect risk markets to do quite well. Now, what we've seen since then is the DXY backtest the 50% level to a pinpoint, a strong rejection candle off it. Now, we haven't broken these lows yet, so it's not yet confirmed, but so far, so good. This might take some time to break down, but it certainly hasn't given us that, straight immediate break above. So we're not leaning towards a risk off moment just yet. The odds are still favoring a risk on rally. Once this breaks down, it's all but confirmed, but by then you'll probably see risk markets have already rallied and started, front running this a little bit.
I have a question on this, and there's the angle that you're looking at it there from that technical perspective saying, really it hasn't broken higher. It looks like it could continue lower. Does this, in your mind, connect to what we're seeing coming out over the last couple of days, this sort of conflict between Elon Musk saying, almost I'm backing away from the things that Trump wants to do with the big, beautiful bill, saying it's a lot of pork barreling, it's a lot of spending that we didn't agree to. So he's painting quite a dire picture. Yet you seem to have the administration coming out saying, no, look, the path to growth is that we have to do all that spending. Do you think that comes into play here when you're looking at that dollar chart specifically, that part of the weakness in that dollar or part of what pushes it for that next leg might be driven a little bit by some of that narrative, or does narrative really not matter at all?
Personally, to me, narrative does not matter at all. I would say that the cycles are in charge and narratives attach themselves to the cycles.
Hmm.
If it was a bullish time for the DXY, cyclically speaking, you would have all of this positive news getting a lot more attention. And when it is a weaker time for the DXY, you have news that is talking about increasing spending and pumping liquidity into the system getting more attention. There's plenty of news for both sides of that market, a bullish and a bearish DXY. It really depends on what you focus on. And to process every single bit of news and then to form an opinion based on that is impossible. You know, even for an AI to even have access to that data is impossible. So the combination of cycles and technical analysis, I think, will probably be a bit more effective than the news. There will be a lot of news coming out if the DXY breaks down from this 50% level, and also cyclically speaking, we would expect it to break down. There'll be a lot of news coming out about spending too much and increased spending, and the tariffs will probably resolve in a way that the favors the DXY going down as well, and risk markets rallying. So that'll probably be some sort of resolution to the tariffs. So yeah, there is a lot of drama going on between Musk and Trump, and the Treasury Secretary as well. But really, at the end of the day, you know, it's interesting because they're pushing this bill, but at the same time, they're talking about cutting spending. So the Treasury Secretary is talking about cutting spending to make the US look more financially responsible. He's backing the bill because he works for Trump, and Trump wants this bill as a populist. The reason he needs to make the US look more financially responsible is because one of the major factors for their recent downgrade by Moody's is that the debt has become unserviceable and they just can't keep increasing the debt endlessly. So his job is to sell government bonds and sell government debt, and he needs to make that debt look desirable. So he's going to keep speaking about austerity because he needs to sell his bonds, and he's going to keep promoting Trump's bills because that's his boss. So he'll do both, and I'm sure he'll do a great job at it. Musk has come in as an idealist. He really wants to cut government spending. He's a businessman. He's looking at this as, you know, profit and loss, and it's just unsustainable. Unfortunately for him, the way the system is set up, there is really no room for austerity in the current system. They need some sort of dictator to come in that isn't running for re-election for that to really work. And to be fair, they'd probably get assassinated. So I don't think there's really any chance, given the central banks and the kind of power they have, and the way the current system is set up, for actually reducing that government debt, reducing that government spending. And that just means hard assets continue going up. Inflation is a problem long term. And it is more important now than ever, because things are getting exponential, for individuals to get out of currency, get into money, get into hard assets, and take advantage of the system of asset inflation rather than be a victim of it by just holding currency that's losing value.
I love that answer, and I particularly love your take because it was a bit of a loaded question. I knew you would go down that path, but this idea that ultimately the news isn't driving these markets, the news is filtered by the markets. If that makes sense, you really have to look at what those cycles were doing first, and then the narrative on top will be, oh well, the dollar went down because of the spending. But if the dollar had went up, it also would have been the dollar went up because of the spending. It doesn't really matter. The cycle ultimately is in control. So that's such a
100%.
good answer. And it is important to keep reminding ourselves of that, because as interesting as it is, it's always much more interesting to be involved in the news side of it and to be engaged in those sort of conversations, because everyone can get passionate about those. But ultimately, you've shown pretty consistently the outcome is somewhat predetermined. Obviously, massive news events that are unexpected can be short-term blips on that radar. It can feel like a big deal at the time, but ultimately it's going to revert to the underlying currents, because the underlying currents are there for a reason. They're long-term structural issues that mean it has to go one way or the other.
Absolutely. And there's two things I'll say about that. You mentioned that, you know, it's more enjoyable. It's easier to get caught up in the news and get passionate about it. So news in that sense, they make money off your emotions, and getting passionate about it is getting emotional about it, and that's great for their ads and for them to sell ads and keep you engaged. But it's not great for investing. So it's cool to get passionate about a TV show or the news, you know the propaganda channels, but to really be making investment decisions, it's really important to just take a cold, calculated look at where things are. And the other point is that you mentioned that massive news articles can have a impact on markets in the short term, but that might just look like a blip when you zoom out. What I would add to that as well is there are phases of the cycle where you'd expect increased volatility, and there are phases of the cycle where you'd expect reduced volatility as well. So, if we're in a phase of the cycle like we are right now, where volatility is going to increase, I would expect massive news stories, and I would expect huge reactions to those news stories. So, for about the last year or so, we've been looking at, well, now we're entering that final phase of the uptrend of the macro 18.6 year cycle, and volatility is going to increase. And then you have a president come in who just happens to be having a style of operation which is very much let's throw stuff at the wall and see what sticks, and it's just how he operates. And he speaks very freely, and he's constantly on Twitter and things like that. So that will increase volatility. Then the tariffs come out, and we've had a lot of volatility on that as well. But you zoom out on the S&P chart and you look at what's happened with the tariffs. I mean, that's just basically a huge wick on the monthly chart, and it's almost fully recovered all of those losses. So that it's probably a good segue to actually look at it now. But the S&P is essentially back at its all-time highs, when just a month ago we were talking about the bull market being over and this being the end of the world and preparing for a full-on recession. That's volatility if I've ever seen it. So,
and to be fair, you were always pushing back on that, no matter how low that got. You were saying, "Let's look," and proven absolutely correct. Looking at that chart, look at it,
yeah,
amazing.
look at that. I've looked at a fair few charts, and I've never seen this type of a V-shaped recovery. This is like the COVID recovery, but it's even it's almost stronger than that in terms of how quickly it's recovered. So the fall might not have been as bad as the COVID one, but the recovery is just incredible. So a couple of weeks ago, we were sort of sitting around this level, this candle here. And we were saying that we're now getting to this point where if we were putting in a complacency bounce or a lower high, this is where we would put it. And the fork in the road was either we pull back and then continue on to new highs, or we just struggle here and start breaking down. And then this becomes the real point where people need to start paying attention and taking risk off the table rather than this point here. So, you sell at those higher prices when you get those weak indicators. But what we've seen since then is a pullback, and it looks like it's breaking to new highs now. So along with the DXY breaking down, favoring that fork in the road of new all-time highs in most markets and a rally in risk, the S&P is confirming that bias as well. Again, it's not confirmed, just like we need to see the DXY, which was here, break down below that low. We also need to see the S&P break above this highs to confirm this. But so far, so good. Um, the reason I'm tracking this is because we said that we would keep a close eye on it, and individuals should track this themselves. But for anyone who's not looking at it themselves, we will provide updates on this until we break these new highs and that fork in the road has been completed. Now, just a few other charts that we looked at before that will probably help build that context as well is we were looking specifically at risk entering markets. So not just the S&P, but the Russell 2000 was a good barometer for that. And where we were was the Russell had broken down below its 50%. So that was obviously a sign of weakness. But in the recovery, the S&P had gotten back to its all-time highs. The Russell was just pushing up against this 50% level. And what we were looking out for was if the Russell can regain this 50% level, it'll probably backtest it and continue up. If this was to eventuate, that means risk appetite is now re-entering financial markets. People are getting more speculative and investing in smaller cap companies. The Russell 2K is basically the small cap index, the smallest 2,000 companies there. And what we've seen since then is it's regained the 50%. It's backtested it. And again, we're just at that inflection point now. If we break these highs here, that's a confirmation. And, we're probably then getting back to this level and this level here. But that shows objective bullish strength in a highly speculative, riskier market. So not only are we getting most markets breaking to new highs, but we're getting risk appetite coming back in as well. And that tends to line up with a flood of global liquidity. So, the DXY would break down. We're probably going to see some form of quantitative easing from the central bank. And dare I say it, we might even get rate cuts by the Federal Reserve. Rate cuts have been delayed for a long time while, inflation's going down. Like we look at trueflation today and you can see that, we're at sort of 1.88. That's quite low. This is the metric that I use more than anything else, but we've seen a downtrend, a bit of what I would call a counter trend rally, and this might be breaking down now. So we could see inflation actually, at least for the short term, for that final phase of the rally, get pretty low. That would help the Fed justify an increase in global liquidity. I do think long-term inflation is very much on the rise, and even if you have 2% year on year, that's not great. And asset inflation is a whole separate problem. So while this has come down, it will probably facilitate a massive rally in risk, but then we would expect an uptick in inflation just based on that liquidity increase. It tends to follow it on a one-to-one correlation, or I would say causation in this case, quite closely.
I do have one extra question on the inflation angle, particularly. When you think about that chart and we say the 1.8 number or 2%, whatever the number is that, I think people are always skeptical about inflation, right? Like, which is fair. And we talk about it as asset price inflation versus consumer price. There's lots of reasons why that number doesn't make a whole lot of sense. But specifically on the Fed and its response, everyone knows deep down in government, surely, that they ultimately need inflation to be high to have any chance at getting rid of this debt, because inflating it away is ultimately the solution. Elon Musk has come out sort of effectively saying that, even though he was instrumental in pushing some of these policies earlier. Now he's sort of coming out saying, look, inflation is a hidden tax. Everyone ends up paying it eventually. They know this, right? Like, under the surface, they know that ultimately they want to get that inflation rate as high as possible that they can get away with. So when you talk about cutting rates, that might be low enough, maybe, that they feel that they can cut the rates and still keep it there, because ultimately they kind of need the inflation. It's not a negative from their perspective.
1000%. So inflation is a problem for hardworking citizens that are getting paid in currency and saving their money, putting it in term deposits, where the interest rate on the term deposit over a long enough time frame has to basically underperform the long-term inflation rate, because the interest rate on the term deposit will also influence the interest that the governments are paying on their debt. And if the interest payments, the rate of interest is higher on a long time frame, higher than the rate at which the debt is being devalued, that means austerity is required. At some point, they have to cut spending. But what allows them to continually keep spending and printing is essentially reducing the value, or the real value, of the debt, which is currency denominated, over a long enough time frame. And that basically, it's like you said, it's a hidden tax. So it's the common everyday person that's funding government spending, and the government uses inflation as a solution to their debt. 37 trillion now, nearly, of government debt, with nearly $1 trillion a year of interest payments, which 9 trillion of which is being refinanced this year. I mean, these numbers are comical. And the 9 trillion that's being refinanced this year at a high interest rate will add like 200 billion in interest payments. So they're completely broke. If this was a business, it would have gone into liquidation a long time ago. If this was a family, they'd be in serious trouble. They'd probably be in prison. So the solution for them is to reduce the real value of the debt. And this is not just the US government, it's every government. And China is doing an active policy as well, where they're devaluing the yuan against gold. And that's how they're servicing their debt. So you see this around the world. Hard assets will be the ultimate beneficiary of it. Unfortunately, for like I said, the hardworking everyday citizen that doesn't understand currency devaluation, that's saving in term deposits, they are the ones that will end up paying for this corruption and negligence by governments all around the world. And it's the individuals that understand hard assets and save in gold and silver and other hard assets that are going to benefit from this, land and even Bitcoin. they will benefit in the long term from this, along with the people that are power hungry that have created this problem in the first place.
Hmm. It's quite sinister if you if you really spend too much time thinking on it. So, but yeah, that's the way it works.
Yeah, that's how it is. And like I always come back to the fact that the solution is really easy and it's really accessible. There's no one in the world or anywhere in the world where you can't access a local bullion dealer or someone that will sell you some gold and some silver. So if you're saving and you're earning, on a weekly basis, you can buy some silver, and on a monthly basis, you can probably buy some gold. So it is a simple solution. It's accessible to everyone, and there's a reason that gold is not spoken about in the media that often. There's a reason that you might get FUD, as we call in crypto world, fear, uncertainty, and doubt around various markets where they don't want too many people accessing it. So central banks have been buying gold like there's no tomorrow, and I would do what the central banks are doing, and anyone can do it. So there is a solution there. Gold and silver, like I always say, they're God given, and this system is like a human made system. So it'll come, it'll go. It might take centuries, but it's transient, just like every other human made system. And you need something eternal that's gonna hold you in good stead and not be a victim of the corruption. But in this case, you will actually benefit from it. So just learn the game, and you can play it well.
Did you have any other charts you wanted to wrap up on here? Because this
Yeah,
has been a really good update, and I think if we just sort of keep that flow going, it'll help people who are trying to sort of keep up to date with your thinking on this.
definitely. Look, I do think we need to look at where we are in the macro cycle. But first, let's look at just really quickly the government bonds. So the US 10-year, this has been a major issue for the Fed cutting interest rates. If they cut interest rates with the US 10-year moving up, quite often, the long end of the yield curve will price in growth and inflation, and yields will actually move further up, while the short end will move down with rate cuts. So that creates a bit of instability in the bond market. Now, long story short, when the 10-year falls off, the Fed will have enough room to cut rates without destabilizing the US bond markets, which they really can't afford to do. So this is an encouraging sign for the bulls that we will see monetary easing, that the US 10-year yields are not going to continue. Well, we don't know this yet, but they're not necessarily continuing up, because what happened was we broke this downtrend with this and we back tested it. And if we saw a move above this, which is that 4.6 level, that would have confirmed that breakout. But we got rejected exactly there, and we're sort of moving down here. So this could just be a little bit of a capitulative move in the bond markets, with all the concern around the tariffs, where the bonds were essentially being sold off by the retaliation to the US tariffs, really. And so if we see the yields falling off, that creates more liquidity in the system. And where we are in the macro 18.6-year land cycle, we would expect a huge increase in liquidity and leverage and greed, and all markets rising together before a broad-based collapse. Now, gold and silver will rise, but they'll outperform after the collapse as well as safe haven assets. So they have a much longer lifespan or more runway compared to most assets. Most assets will have a really strong run-up in this final phase and then struggle after. Gold and silver will have a really strong run-up in this final phase, but then really, really have a great run-up in the next phase. And just to show you what I'm looking for, the final phase of this land cycle is a divergence between the land markets and the S&P. So we can see with the S&P, it was basically back at all-time highs, right? So this is the land markets in comparison. They bounced off the 50%, and they haven't, it's a bit of a lackluster bounce. We might start seeing these sort of slowly move up, maybe put in a lower high or a double top. And that's where that divergence will start happening, where you might see the S&P actually put in new highs while the land market sets into a bit of a downtrend. And you can see that that's what happened in the end of the previous land cycle, which was the 2008 global financial crisis. In pink, you have the land markets falling off, and in blue, you have the S&P putting in that final blow off. So we could be seeing the start of that divergence now. That's a really macro thing. It takes months and months to play out. But that just aligns with the 10-year yield rolling over, the DXY rolling over, risk appetite re-entering the Russell, the S&P breaking to new highs. It all fits in perfectly with expectations for where we are in this macro 18.6 year cycle. So we're right on track. We would expect all assets to rise together. We would expect a flood of liquidity and leverage within complacency and sentiment, and then some sort of financial crash where gold and silver really outperform before, during, and after. And we probably should touch upon gold since we're a gold channel, I guess. But gold broke out. This is huge. I don't know if too many people are talking about this, but this was the gold all-time high. We've been consolidating, and a couple of days ago we had that strong breakout candle. So, I mean, gold could be getting ready for a really strong leg up as well. And with that expectation that all markets rise together, we could see gold, the S&P, everything move up together. With the DXY falling off, would really benefit gold as well. The US 10-year yield falling off would benefit gold. So we could see a huge rally in gold, and silver might outperform gold in this phase as well. So, yeah, look, the winner's curse is where everyone wins so much you can't really do too wrong. So everyone will feel like a genius for the short term, but just keep in mind that that tends to end quite badly, and it's important to take a long-term view. So gold and silver will allow people to take that long-term view and benefit in this phase and the next. So not the time to get greedy. And we'll keep tracking it, but with that inflection point is certainly looking like we're going to see a pretty strong rally across most markets now.
Look, always love the depth of analysis, but particularly around the confluence of those factors that you keep talking about, things coming together, is really important. And the fact that you keep coming back to the same things to look at, because often a lot of analysts will pick one thing one week, something different the next week, and they don't. It just makes them always right, but it doesn't give you that consistency that you can build up confidence over a period of time when you see it unfold. So I think that's really important and really valuable. Look, thanks as always for your deep dive on that. We'll continue to watch it, as you said, and we'll get you back again soon to update us again. But really solid update today. Thank you for that.
Thanks, Chris. Always good to talk to you, and have a good night.
Yeah, you too. Thanks everyone for watching. We'll chat again soon.